thanks for being with me today. Just give us an overview of private credit and what it is.
Look, quite simply, private credit is any lending occurring outside of the banking system. And look, it's very prevalent in the US and European markets. Currently in the US, private credit constitutes about 91% of their lending market. In Europe, it's about 63%.
It's been around for a long time in those markets, hasn't it?
It certainly has. And look, in Australia, it's probably a little bit skewed because of the oligopoly the banks have. So we've got about 11% in private credit, which is around $133 billion in our domestic market.
And traditionally, it's been the preserve of ultra high net worth investors and family offices, and you basically are bringing it to retail investors now.
That's right.
How do we explain to retail investors how a private credit fund works?
Yeah, it's actually relatively simple. What we're trying to do is effectively take what has been used by the banks to generate their profits, being lending directly to businesses, and bring that out to the retail market. So we provide warehouse funding to lenders.
Instead of lending the money directly to the businesses, you're lending to originators, is that right?
That's correct. And another way you can attack private debt is to go to the corporates directly. Now, that's not something that we do at this point in time. We prefer to select what we see as the best of breed lenders in the market and provide them with warehouse financing.
Let's talk about the risks. How have you structured the funds to protect investors?
Yeah, so with any lending, there is risk. And what we look to do is ensure that we're lending to quality businesses at first and foremost. So if you've got a business that has strong cash flows, a strong balance sheet, and is looking for capital to grow, that's the target for our lenders. Firstly, so you're looking at the quality at the actual business level, and then it comes to the lender. We spend a lot of time working, screening the market for the best of breed lenders and looking for lenders who have strong risk mitigation practices. The other thing we look to do is have the lender put their own equity in below us as a first loss piece to protect investors' capital and our returns.
There's protection because you're selecting particular businesses to lend to. There's also protection because the originators, the warehouse financing that you're providing the money to, they're also putting up their equity at risk. So they're aligning their risk with the investor's risk, and they lose first.
That's correct. They lose first, but if their pool is clean, it maximises their revenues. So there is a strong alignment of interest there.
And at the time that we're recording this video, there's obviously concerns about the state of the economy, particularly in the construction space and in retail, but you've not been lending to that space for precisely this reason, is that right?
But we've been actively reducing our exposure to construction over the last 18 months. Now, this construction sector was very strong in the COVID timeframe, but obviously as interest rates have increased, it has put more pressure on the construction sector, particularly where they've got fixed price contracts with variable priced inputs.
By having a fund manager choosing the businesses to lend to, that removes another layer of risk for investors.
It does mitigate it, and that's how we actively manage our portfolio, looking at the areas of the economy where there may be strain, looking to pull back from those and looking to deploy capital into areas where we're seeing relatively good times. And
you're only lending for growth capital, you're not lending to distressed businesses.
That's correct. Distressed debt is not something we do. We're looking for strong, going concern businesses, looking for growth and profit initiatives there.
So Brett, you've shared with us some of the advantages of the fund and some of the benefits and quite attractive features. But what are investors telling you they like about the funds?
Yeah, I think some of the key feedback that we get from investors, they really like the monthly income that we've been producing to date in both funds. The fact that we've had stability of capital since inception across both funds is also very important. And that really drives from the fact that the underlying assets are not correlated with public markets. So I suppose monthly income, seeing the capital stability through there and the uncorrelated returns are really important features for our clients.
And if I can just add, that capital stability and that monthly income, at least for the older fund, the Aura High Yield SME Fund, has been generated even during the COVID pandemic years.
That's correct.
Brett, it's been terrific having you with us today. Thanks for sharing your knowledge and your expertise. We look forward to talking to you again soon.
Thank you very much, Roger. Thank you all.